I would like to address the stockbrokers. My name is Wade Cook, and I wrote a book called Wall Street Money Machine, and my new book is called Safety First Investing, and I'm pretty confident that you as a stockbroker probably heard of me. The person that has given you this tape is a person that's come to my seminar, and they've given you this tape, this videotape, because they want to do certain kinds of trades in their account, and they would like you to understand a little bit more about these types of trades, especially like bull call spreads, and some of the spreads that require 2 sets of commissions or 4 commissions. And I'm going to suggest to you that a way to help your client here, the person that gave you this tape, and a way to make more money for yourself is to learn how to do these trades and do what I call the meter drop, which is to make a whole bunch of money in smaller bite-sized pieces. Now, I understand that you have your way of doing business, and I surely do not want to impose upon you any requirements to do certain things with these clients or this person that gave you this videotape, because that is up to you and them. I just want to teach the strategies. You have to decide in your wisdom if with your firm, if you want to do these types of trades with the students that, or my students, or your clients that are giving you this tape. And that is totally up to you, because some of these trades may seem a little bit aggressive. To some of us, they're not that aggressive, especially these types of spreads. Now, as you well know, as being a stockbroker, that a spread is created when you sell a call and buy a call on the same stock, or sell a put and buy a put on the same stock. There's a problem when we do debit spreads, like bull call spreads or bear put spreads, in that if we're exercised on, there could be 2 sets of commission. And if those options are exercised on, for example, if we have purchased the $90 call and we've sold the $95 call, and the stock stays above 90, which is what we want it to do, and we get called out at 95, if you exercise the stock option, it could be a lot of commissions, and then we have the $90 exercise and the $95 exercise, and the commissions could just eat up any profits. So in doing a debit spread, like the $90, $95 bull call spread, we're hoping to, like for example, have a net debit of $4,000. And on the $5 spread, we get to make $5,000 minus the $4,000 and keep $1,000. And I, as an educator, have shown your students that this is a pretty good deal. But if the stockbroker takes a set of commissions going in and a set of commissions going out, that there may not be very much left on that $1,000 to do. And a lot of stockbrokers have not heard of SDS, or same-day substitution. Now, I'm sure your trading department in Chicago or New York has heard of SDS, or same-day substitution, wherein you do not exercise on the stock, you exercise on the option. And you substitute the options for the stock. Therefore, a typical commission, for example, putting together a $5 spread for 10 contracts, and by the way, I've told your students to do 20 contracts at a time. I think that that's a good way to go. But even on a $5 contract and 10 contracts on a $5 spread, the commissions going in should be like, anywhere from $60, $80, $100, something like that. And then the commissions coming out should be nothing. So what I've asked my stockbrokers to do, and I've had 9 different stockbrokers that do this, is to take a commission going into the deal, but not a commission coming out of the deal when we unwind the deal or get exercised on. And then if the stockbroker only takes a commission on one side of the deal, then there's enough profits left to make it worthwhile for we investors to do that kind of a deal. And if the stockbrokers get greedy and have to have commissions on both sides of the deal, then there's just not enough profits left. Now, 2 of my stockbrokers, they have divided the commissions in half. Instead of $60 going in and then nothing coming out, they do 30 and 30, and I'm all for that. So that they show on their books that they're making money on both sets of the deal, the spread coming in, the spread going out of the deal. Anyway, those are bull call spreads. As you know, bull put spreads and bear call spreads are credit spreads, and there's no second set of commissions coming out. But I wish you well in working with my students. They probably have studied my books and my tapes, especially Safety First Investing, and some of my books that have a lot of information about bull put spreads and bear call spreads. And I invite you all, matter of fact, I hope as a Christmas present they buy this book for you and get you up to speed on these kinds of strategies so you can help them make a lot more money. And I thank you for listening. Let's move on now. Let's kind of put a summary on these 4 types of spreads, and then we're going to do index spreads and calendar spreads, and then that'll wrap up the seminar. Page 37 is kind of a synopsis and a way for you on one page now, to write down, and so you have it firmly in your brain which kinds of spreads you're going to do. There are these different types of spreads right down the center of the page. You have at the top the bull call and the bear put spread right at the top of the page. Matter of fact, I think I'll move the manual down here so you can, I'll just be right with you. Okay? You have the bull call and the bear put spread right there. Those spreads are debit spreads. Do you all see that? So you can just, you understand it. So a debit spread means what? Does it mean you're spending money or taking in money? You're spending money to put it into place. And for it to work, you have to get exercised on. A bull call spread, you have to get exercised on, right? You have to be called away. And in a bear put spread, you have to have it put to you. Therefore, you have that second set of commissions. So a debit spread where you spend money also means 2 sets or 4 commissions. But let's go down to the bottom. A bull put spread and a bear call spread are credit spreads. You take in money. You generate income into your account. And upon expiration, they just expire worthless. You get to keep the money. There's no exercising, therefore, no second set of commissions. Now, I just wanted on one page to put all this together. So whenever you have a question, what am I going to do today? A bull call or a bull put or whatever, what am I going to do? You've got to ask yourself, how much profit is there and what kind of commissions do I want to pay? Because I'm not convinced that what I just said there to your stockbroker is going to work. Right? That on a bull call spread that they're going to let you have that commission for nothing on the other side of it. If they're not going to give it to you for a real heavy discount or zero, then you're going to have your profits go away very quickly. So my suggestion is that you get really good at bull put spreads and bear call spreads. Now, when are they both used? When do we use? Just for your own notes right now, this is your notes, and I would write very neatly here. I know I'm watching a bunch of you writing again, and you're not writing very neat. You're going to get home and say, what did I write there? I can't even read my own writing. All right. What are you going to do when a stock is low, on a temporary dip, hopefully, or rallying into a news period of time, or into an earnings report, and everybody's saying it's going to be good? Which strategy would you use? The bull put spread. And why a spread in the first place? Why not just buy a call? Because in a call, you have a 1 in 3 chance of making money. By doing a put spread, you've sold a put, or you've sold the call, and you have a 2 in 3 chance of making money, right? Because if the stock stays the same, you make money. If the stock goes up in a bull strategy, you make money. In a bull put strategy, in a bear call strategy, if the stock stays the same or goes down, you make money. When you sell, you have a 2 or a 3 in 3 chance of making money. When you buy, you have a 1 in 3 chance of making money. So you want to sell the calls and be naked, and you want to sell the puts and be naked on the stock. The problem is that there's too much risk associated with that. So in a bull put spread, by buying the underlying put, you've created a spread, stopped all the heavy-duty margin, and they allow you to do it. In a bear call spread, you sold the call, right? You've written a naked call, but by buying the upper call, you've created a spread, you've stopped the upside risk, therefore you've created a spread, and there's limited risk, limited profits too, but limited risk. So the reason we do spreads, because we have those extra chances of making money, even though they're limited. In theory, you would make more money just buying a call, being pure long on a call, rather than doing a bull put spread, right? But then you have all the risk too. In the long run, you may make more money just doing a pure call, but what if it doesn't work? That 1 in 3 chance of making money. So at some point in time, you got to say, I'm about a $5,000 or $8,000 type of trade kind of guy or kind of gal. That's where I am. I'm going to put about $5,000 to $8,000 into all these trades. And I'm happy to get 20%. I'm happy to take $8,000 and get $2,000 or $3,000 a month. Y'all understand that? And that's where I am. Yes, I know that I could possibly take $8,000 and make $24,000 and get a wild hit once in a while. But that's not who I am. I am a steady income kind of person. And I'm going to just get good at this. By the way, could you get so good at this that you could even train family members and employees to do this? But you probably can't train family members to go out and buy calls and hit it all the time and make you rich. But you can on this. It's learnable, it's doable, it's achievable, because it's steady, steady, steady. If you want a wild strategy to how to take $8,000 and make 30, 40, 50,000 bucks every other week, then it's not this seminar. Sorry, it's not this seminar. If you want to take $8,000 and learn how to make $2,000 or $3,000 once a month, then it's very doable. So you got to say, am I this kind of person? You know, is this what I came here for? Is this what I bought this video set for? Now, I'm not suggesting that this is for everyone. There's a lot of people that need to make a bunch of money. That couple I told you about and bragged on just a minute ago, Kent and Dana, that paid for all the medical and all the stuff that went around adopting those 2 babies from Cambodia. They couldn't have done bear call spreads with $7,500 and made $30,000 in 1 month. Y'all understand that? They couldn't have done that, right? What they hopefully inspirationally did was do what? They took their $7,500, in, out, made $30,000, right? And I don't know if they'll ever do that again. I think that was kind of a freak month so they could adopt those babies. Anybody have that kind of stuff happen? Like serendipity strikes. It was right with God for them to do that, and it probably happened because of God, not because of them. Because those babies needed to be adopted. But other than that, if you want steady income, though, then this is a steady income kind of strategy. All right, now, we're going to pick up the excitement here a little bit, because once you understand what spreads you're after, now I want to show you index spreads. These are some of my favorite types of spreads. So I'm over now on page 41. Index spreads. What is an index, first of all? What is an index? Well, let's go through and explain a couple things at the top of page 41. Somebody's done a lot of research, and they've determined that in regards to a stock movement, that 70% of a stock's move is determined by the market in general. By the way, could anybody pretty much say that for the last month or two? That any high-tech stock, any internet stock, any of the Dow 30 stocks have pretty much been moving according to the market, right? They're all moving together. Maybe that has a lot to do with news, no news, red light, green light. Maybe it has to do with, when internet stocks get way too high, they all get hit. Right? 70% of a stock's movement has to do with the market in general. 20% of a stock's movement has to do with the sector that it's in, the arena that it is in. So you'll see a lot of the oil stocks, or a lot of the internets, or a lot of the banking stocks move all at the same time. And now lastly, 10% of a stock's movement. 10% of a stock's movement is by the stock itself. This is according to what that company, that stock, that pricing, that PE, that news is doing of the stock itself. I don't know who did this research, but I got to tell you, from all my studies, it's pretty darn close. So if you want to know what's going on with your stock, you can look to the market more than you can to the particular stock. Well, if what I'm saying is the truth, and I think it's pretty darn close to the truth, if what we're talking about here works, and most of the stock's movement is according to the market or according to the sector that it's in, then wouldn't it be safer than just to play the whole market? I mean, instead of trying to gamble on one little stock is going up and down, or going up and up and up, what if the whole market? So let's look at the whole market. Let's get a chart up there for the Dow. And then we'll put up there like the Standard & Poor's 500. Let's take a look at this. Let's see if there's a way, instead of doing rolling stocks, if we can do rolling markets. Make sense? Because if the whole market causes a move in any particular stock, why not invest in and deal with the whole market? Okay, do we have that? This is the Dow over this last year, just from 98 on. Nice move. By the way, go back here and look in February and March of this year. Look at that part right there. A little bit of a roll right there. Look at that. Then it spikes up, starts to roll again. There's a range rider all the way up. Gets clear up in the 11,000 range and then backs off. And it looks like it may be establishing a new pattern. All right, now let's go ahead and put up here. This is the Dow 30. Let's put up here the S&P 500. All of them, the 500 largest companies in America. Okay, look at this roll pattern. Now, it had a very interesting year, earlier, but look at this. As it gets up there, look at this roll pattern that it established everywhere. Look at that, up and down and up and down. Look at that whole thing. So why not learn how to play the S&P 500? When it gets down, buy calls. When it gets up, buy puts. Write it back down. So what is the S&P 500? This is the grouping of stocks that are made up of the 500 largest companies in America. Well, so somebody puts together an index. What is an index anyway? Basically, it's an artificial conglomeration of stocks. Somebody's put together a bunch of stocks, usually on a weighted basis, and says, here, this amount, this number here, represents a conglomerate pricing of all these stocks if you were to own them. Now, I got an interesting comment for you. That is what an index is. But of the S&P 500, the Standard & Poor's 500, I don't know if this is exactly true today, but this has been true, and something like this is pretty much true now. Of the 500 largest companies in America, I read a report a little bit ago that said of the 500 companies, 37 of those companies make up 53% of the market capitalization of all the 500. All right, let's explain what that means. Market capitalization. The market capitalization of any stock is how many shares are out in that company times the share price. So if there's 18 million shares at $32 a share, then you have a market capitalization by multiplying those two. Well, you take all 500 companies, their market caps, right, of all 500 companies, and you add all, that's billions, that's trillions of dollars. But 37 of the 500 companies make up over half of the market capitalization. So if those 37 companies move quite erratically or quite quickly, could that affect the whole marketplace? Even if 2 or 3 of them. How many of you have seen a day where even if an IBM is down $18 in one day, the whole Dow is down with one stock going down? I mean, literally, 29 other stocks could be flat or go up a little bit, and one stock could have the whole market down, can it not? So one huge company like that can affect the whole marketplace. I got a question for you then. If 37 companies make up 53% of the deal, and you want to invest in big-time America, why not invest in those 37 companies? Well, we don't have those 37. The next best thing is what is called the S&P 100. The ticker symbol basically for the index is called the OEX. It's easy to remember because it's O for 100, the 100. The Standard & Poor's 100 largest companies in America, that ticker symbol is the OEX, and that is my favorite index to invest in. I think it is the most widely traded index that exists. All right, let's go through page 41. There are some other common indices, all right? One of them is the Dow Jones. Now, for many, many years, the Dow would not allow its name to be used in any index or anything. People were always trying to sneak around and do it, but it never worked. They put together trusts that owned the 30 stocks in the Dow and all that. But about a year and a half ago, 2 years ago, I think in the end of 96, 97, the Dow let their name be used in these different indices. So you have the Dow Jones Index, the DJX. That index represents the Dow 30 stocks. It trades at 1/100th of what the Dow trades at. So in the example there, if the Dow is at I'm going to change these numbers here. If the Dow was at 10,840, then the DJX will be at $108.40. Do you see how that works? It trades at 1/100th of, I'll do it again. The index will be 108.40 if the Dow is at 10,840. Now, it also moves the DJX in $1 increments, $1 strike prices. So there's a 99, which would represent the Dow at 9,900. There's a 10, there's a 100, there's a, what do you call it, 108. 108 would be 10,800. Y'all see how that works? If it's 110, that would be 11,000. The Dow at 11,000, the DJX would be at 110. Right? So there are $1 increments, strike prices on that. Right? And it has what is called an AM settlement. Okay, let's turn the page, and you'll see 2 other indexes that are very popular. Well, these are not that popular, but they're out there, and you should know about them. The Dow Jones Transports, which is ticker symbol DTX, and then the Dow Jones Utilities, which is DUX. Now, the Dow Jones Transports trades at 1/10 of what the transport average is. There's a typo right there. It trades at 1/10. So if the Dow Jones Transportation average is 32.40, the DTX is 3.24, and there are $5 strike prices. Now, the Utilities Index trades at dollar for dollar. If this is at 297, then the DUX is at 297, and it has $5 strike prices. Now, I have an explanation on page 43. I'll let you read that at your leisure about what is the difference between an AM settlement and a PM settlement. Now, there's something very important here that we're going to cover as we turn the page as you look at these other indices. But let's just stick there on page 43 for a second. You see on the bottom of page 43 where it talks about European-style options. Now, if you remember this discussion, if you've read any books about it or if you've been to the Wall Street Workshop, do you remember where we talked about the European and American-style, right, options? In an American-style option, you can exercise on the option any time on or before the expiration date. And by the way, it does not close off at 4 p.m. on that Friday. Even after that, people can be exercising their options, right, to buy the stock or to put the stock to someone. For the purposes of buying and selling the options, it closes when the stock market closes, right? It closes when the option market closes. But exercising can go on after hours. All right. It is American style anytime before the expiration date, on or before the expiration date. European style is an option that can only be exercised on the expiration date. Now, you notice I didn't say it can be bought and sold only on the expiration date. I did not say that, right? Because you can buy, even European style, you can buy and sell those all day long, but you can only exercise on the expiration date. Now, that is for stock options and all kinds of things, European style. And for your information, most of the world travels, or most of the world trades European style. Now, when it comes to indices, think this one through. You have an option on an index. You are saying, I believe that this index is going to go up. If the OEX is at, say, 840, can you find out what the OEX is for right now? If the OEX is at 860 and you think it's going to go up, You can buy the 860 call options. They're very expensive, by the way. And as the OEX moves up, we'll show you how it does that in just a minute. As the OEX moves up, your call option goes up in value, just like owning the stock. If the OEX goes down, and you think it's going to go down, you may want to sell a call rather than buy a call. Same thing as a stock. Here's the point, though. Most, except for the OEX, that's American style, most of these indices trade European style, which means that they're only exercised on the expiration date. What does that mean? All right, what I need you to write in your notes there, and I've got some explanation of it later on, but these indexes settle for cash. You need to understand that, and that's very important, and I hope you like this explanation. I hope you like this part of this. They settle for cash. How can you get an index put to you? How can you get an index called away from you? It's not like owning stock and getting stock taken away from you. It's not like selling a put and getting stock put to you. You get an index put to you. What? What is an index? It's an artificial conglomeration of stocks. It's what somebody thinks that these stocks are worth. How can you get it put to you? So it's really quite simple. If you bought the 860 calls on an index for, say, $9, and that goes up to, say, $8.80, on expiration, you won. You made money. And you're going to have $20 cash in your account. Let me say it again. Indexes are cash settled. You don't get an index put to you or called away from you. You won on this deal. You gambled rightly, and you're going to have $20 into your account. So what's your net profit on this deal? If you spent $9 to buy this and you get $20 in your account, how much net profit do you have? $11, maybe $11,000. Do you see how this works? Likewise, let's say you lost. You were hoping that the option was going to go up, that the index was going to go up, and that your $9 was going to go up. It went down. It goes down to $8.70. Whoa. It goes down to $8.50, sorry. It goes down to $8.50. What's going to happen on expiration? You're going to have another $10 taken out of your account. Y'all see that? It settles for cash. And what's the advantage of that? The advantage of that, win, lose, or draw, it's done. You don't have stock put to you that can go down in value. You don't have to worry about the stock writing covered calls against it, selling it, doing anything right, because this deal is over and done on that third Friday or that Monday. You know it's done. You got cash in your account or you got cash out of your account. Y'all see how that works? It settles for cash, and the deal is over. Owari. That's Japanese for finish. Fini. Kaput. Done. Over. Okay, now I hope that some of you appreciate that because you kind of want to get on with your life. All right, now on the next couple pages, there's just some more listing of indexes. Now let's show you some trades with them, though. Let's move on now to page 40, to page 46. Buying calls and puts. Why do you do this? We invest in indexes the same way. We do options, puts, and calls on indexes exactly like we do on stocks. There just happens to be some safety in numbers. If you think the whole market is rolling and it takes a dip and it starts back up. For example, at the time we did this video recording, just last week, the Dow had gone from like a month ago, in the beginning of May, from around 11,000 clear down to around 10,300. How many of you wish more than anything at that time that you would have bought some options on the Dow index, right, when it was down around 10,300? Because now it's 10,800, right? You'd be almost doubled your money on these things. You see the point? On whatever those calls were going for. Right? So if you think the market is on a peak and it's going to come back down, by the way, when it got up to 11,200, I bought some puts. I just did not see it sustained. I think it had a hard time with 11,000. I said it's going back down under 11. Did it, by the way? Didn't hardly take any time at all to get back down under 11. Is it going to have to try to test that ceiling a lot before it breaks through and goes to 12,000? Yes or no? So you're going to see a lot of roll patterns. Can you take advantage of those roll patterns? When it has a good support level, can you take advantage? What about when it has a good resistance level? It has a hard time breaking through. Okay, then every time it starts back down, buy a put. Every time it hits the bottom and bounces back up, buy a call. Or one other type of trade. But let's finish off these 2 pages here. The settlement is a cash settlement, as I told you. Now, the same thing happens in selling calls and selling puts. Okay, but I got to show you how it works. What is the OEX at? 655? 665. Okay, the OEX is at 665. I want to show you something here, so you can put this in your notes on page 46 under number 4, selling calls and puts. It's at 665. I'll show you some ratios here as we get over to page 47 in just a second. You could sell puts on this. If you think it's going up, You could buy calls. That would be one strategy. And that costs money. And there's a 1 in 3 chance of making money. You could also sell puts. Oh, now once again, we have what? A 2 in 3 chance of making money. Because if we sell a put, let's say the 665 put or the 660 put, if the index stays above 660, we get to keep the money we made for selling the put. If it goes down even a little bit or goes up, we make money. You see the point? So even in doing index trades, playing the whole market, we still have the same availability, the same strategies available as if playing a particular single stock. And it's even more important than that, because watch this. Well, it's not more important, this part, but I want to show you the margin. I want to show how this will affect your account. Let's say that the 665 calls are going for $6 for whatever month. And you want to buy 10 contracts, that will cost $6,000, just like a call option on a stock. How will it be treated if you, let's sell it this time. Let's say that let's just change around right now and say we're selling the puts for $6. How will it be treated for margin? 665 and 10 contracts are going to be treated as if it were $66,500. If your margin is right around 20 to 30%, you will have to have on hold 20% of that or 30% of that, or about 20 grand, let's say, $20,000 to make $6,000 for selling the put. So for margin requirements on an index, they'll treat it just like it is a stock at a 1/100th reverse. Okay, that's what they're going to treat it. So 665 times 6 times 1,000 shares is 66,500. Y'all see how it calculates? I think, is it a 1 for 10? What is it? Is it a 1 for 10? On the ratio there. Just write those numbers down. So when your stockbroker says you want to sell a put on the index, he'll say, well, that's going to be about $20,000 on hold in your account. You'll know what he's talking about. By the way, $20,000 on hold to make that $6,000, is that a pretty cool deal? Could be. And that's why I like indexes, because they treat it just like a stock for that purpose, but it still settles for cash. All right, now let's see if we can make these trades come alive. Okay, there's enough on the margin, cash settlement, we've done all that. Now, let's go over here and look at the DJX. Okay, the DJX, again, represents the Dow Jones 30. All right, now, these are pretty widely traded, but nowhere near as many contracts written as there are on the OEX. Therefore, my favorite is the OEX. Why invest, why trade in thinly traded options or even index options? Some of these indexes I showed you on the previous pages, there may be an open interest of 80 or 90 contracts. We're on the OEX at any given strike price. My goodness, there are 13,000 open interests, 13,000 contracts. There's a lot of movement, a lot of trading, and you just don't want to become the market. You don't want to buy 50 contracts on the DJX. Okay, what is it at right now, David? 107.66. Okay, this is the DJX. All right, now, the irony of the DJX is, remember that we have $1 spread increments. We have $1 spread. We can do it. We can do a $1 spread. We could sell the 107 and we could sell the 108 and buy the 107. We're going to, though, do a bull put spread. So here's what we want to do. Let's do the 105 and the 100s. We're going to sell this one and buy this one. And what are we thinking about when we're doing a bull put spread? Whether you're doing it on a stock or on the index, what are we hoping for, everyone? That it's going to go above or what? Stay above what? 105. 105 represents what? And in your mind, it's got to say 105 represents 10,500 on the Dow. Y'all see that? And so maybe you want to do the 104.99s, the 103.98s. You see the point? Because you got to say, what could the Dow go down to? You know, could it take another dip? Is it going to test that bottom again? What did it get down to a few weeks ago? 10,400. Now, the irony of this whole thing is that somebody's going to be watching this video a year from right now, and the Dow's going to be at 13,000. They're going to say, golly, it was clear back at 10,000 when they did that seminar, right? I'm going to have to come in and redo this part. Okay, we don't know where the Dow is going. And conversely, it could be, whoa, the Dow right now is at 7,400. They were doing that video when the Dow was at 10,400. Good, buddy. All right, let's go. What are they? Okay. All right, this is pretty interesting, guys. Okay, we're going to sell the 105s. We're going to sell this one at 1/2. And we're going to buy this one at 1/8. Does everybody see the 3/8 there already? No? Yes? Or where are you guys? Okay. Let's do 10 contracts just for simplicity. $500. We spend $125. We make $375. How much is on hold, David, in our account? The 4,600? Okay, not very much money, right? Because why? Because there's not very much risk. Right? All we have to do is have the Dow stay above 10,500. You want to see a risky one? Then let's go to the other side. We're doing a bull put spread. How about doing the 10,500 Dow and the 11,000 Dow? Right? The 105 and the 110. If you really think that the Dow is going to go back above 11,000, I guarantee you this number is going to turn around a lot. Watch this. Again, I'm doing the DJX. The DJX is at 107.66 today. What are the 105? We already have the 105s. What are the what are the 110s now? 2 and 9/16 by 2 and 13/16 on a $5 spread. So here's what we do. We sell this one and we buy this one. Let's just say that this were 5/8 too. This 9/16 is 5/8. Does everybody see the $2 right there? $2. Net credit on a $5,000 hold in the account. So we're going to have $3,000 on hold to make $2,000. Is that a nice return? But the Dow has to go where? Way up above, well, it has to go above 11,000. How many think that that may be pretty tough before June expiration date? Anybody here? So you're not going to make this kind of money. Even though it looks good on paper, you got to look at all the surrounding circumstances, and it's probably not going to happen. Okay, now I don't want to belabor these DJXs because I don't play them very much. What I want to get down to is, as a matter of fact, let's just skip the SPX. What I want to get down to is the OEX. These are the ones that I play. So can you look up the OEX again and get those ready to go? All right, I want to show you something on the OEX. Again, the OEX represents the S&P 100. What I'm going to show you right now is not an exact ratio. It is not exact at all, but it's pretty darn close. So I'm just going to tell you what it is, and then we'll learn how to deal with it as we do the examples. A 1-point move in the S&P 100, the OEX, equals about a 16-point move in the Dow 30. Y'all catch that? So you need to get that ratio in your brain. 1 for 16. It used to be 1 for 8, but the OEX did a 2-for-1 split about a year and a half ago, 2 years ago. So it's now 1 for 16. 1 for 16. Now that's going to be very important because in your brain, will you all agree with me that the Dow 30 is the most widely followed index in the world? If somebody says the OEX is up 5 points today or up 8 points or down 9 points, you probably really don't even know what that means, right? But if somebody says the Dow is up 80 or the Dow is up 130 or the Dow is down 150, we follow it, and so does everybody else in the world. Even though it only represents 30 stocks, it's still the most widely followed index. So the reason I'm showing you this 1 for 16 ratio is because we're saying that we're going to do an OEX deal, and we need the OEX to move up 9 points, or let's say 10 points. If the OEX, we need it to move up 10 points for us to make option money, good money on our options, what does 10-point move in the OEX equal in the Dow? 160-point up move or 160-point down move in the Dow. Y'all see how that works? So just for ease of calculating it in your mind, I give you that 1 for 16 ratio. So when I say, well, let's do it. Let's do it. Let's look at the OEX, and here's what I would like to do. What do you got, David? What is it at 655? Okay, 665. Let's just go there. 665 plus change. All right, now, I'm going to do something really interesting in one fell swoop and see if you guys like it, see if you understand it, and we'll explain it, and then we'll be done with this index spreads, because this is all that I do, by the way. I do this all the time, what I'm going to show you right here. I go down, and I do a, I go down here, and I do a bull-put spread. If the OEX is about 665, I'm probably going to try to do the 640s, 645s. And then, in thinking that it might not get above a certain strike price, I'm going to do a bear call spread over here. And at 665, I'm probably going to do the 685, 690s. Now, this may not work exactly, so I'll use a different color of ink here in just a second. These are puts. These are calls. All right? Now, before we put any numbers up here, does anybody see what I'm trying to do? What I am saying is I can do a spread far enough out of the money that I will never get it put to me. Right? The OEX would have to drop 20 points for it to get put to me. 20 points times 16 of the Dow represents how much? 320. Well, the Dow is right now at what? 110.6 or so? That means it'd have to go down to 10.3. I'm sorry, by next Friday, I just don't think, this is me talking, that the Dow is going to be at 10.3. It tested already at 10.4. It bounced off of that, went back up nicely. We're heading into the news period of time, right? I think it's going to do okay in the 10.6, 10.8, 10.9 range in the next couple of weeks, the next month. But I also think that the Dow, if I write the 685s, I'm 20 points out of the money. I'm 20 points away from this strike price. I'm not going to get in trouble on this strike price, right, at the 685. Because the Dow would have to go where? It's right around 10.6, 10.7 right now. It'd have to go where by next Friday, a week and a half from right now? It would have to go up to 11,000. It would have to go up 20 points times 16 is how much? 320 or so, 300. So it'd have to get back up close to 11,000 in the next 10 days. Sorry, I just don't see it. So if I do a bull put spread and a bear call spread simultaneously, and the Dow and the OEX just floats anywhere between 645 and 685, am I okay? And then what will happen on expiration date? I'll get to keep the net credit money I generated by doing the bull put spread, and I'll get to keep the net credit money I generated by doing the bear call spread. How many like this idea? And how much of a float do we have here? We got from 645 to 685. That's a 40-point float that the Dow can move, right, times 16. That's a 600-point move in the Dow that we have to play with. And we're okay either way. And by the way, if we lose on one, we're definitely going to make money on the other. Right? So the worst it could probably be is almost close to a wash. Let's do it. Let's do it. Okay, give me some numbers now. Let's see if this works.
45 puts, 2 3/8 by 2.5.
Okay?
640s, 1 3/4 by 2.
Not good. Does everybody see it? It's not very good. Okay?
690s, 1 by 1 1/8.
All right, let's do this one first. We're going to do the bull put spread first. Ready? Let's go on these numbers. Let's do this one first. We're going to sell this one and buy this one. Does everybody see the 3/8? Would anybody do this for 3/8? Yes or no? Got a $5 spread, $5,000 spread basically to make $375. So you got $4,600 on hold to make $375. It's not worth it. How about moving up one strike price? So David, give me the 650s just for fun. Okay, so in this example, we sell this one and buy this one. We could probably work this one for $1, at least for 7/8. Do you all see that? No? Yes? So you guys see it? So 7/8, because we're going to sell this one and buy this one. So that'd be $3,125 for selling it, but we're going to spend $2,500. At the market, it's $625 or 5/8. But could we have our stockbroker work it a little bit? On any kind of a dip, we may pick up 7/8 or 3/4 or even $1. Would that be a nice deal? But now we're only $15 out of the money, not $20 out of the money. So now you take 15 times 16 points, move, and you can see where you would lose money. Okay, so is it still good? I like it. We're still saying that what would this 650 represent? So if it's at 665, that would represent a 15 move. What's 15 times 16? 250, 240, something like that. So it's still a $240 down, a 240-point move down in the Dow to get in trouble. All right, let's try the bear call spread. The bear call, we're hoping that the Dow does not go above 685. So in this example here, we sell this one and buy this one. Okay, let's say we could get this one for $1 instead of 1/8. Right? We can work it a little bit and get it for $1. Does everybody then see the 3/4? Yes or no? Do you see it? Okay, let's do it together if you don't see it then. We're going to sell this one and buy this one. Sell, buy. We sell this one for $1,750. We buy this one for $1,000. We make 3/4 or $750. It's a $5 spread, so we have on hold in our account $4,250. How many think $750 return on your money for $4,250 put up on hold, right? Because it's a credit spread, is it not? So we're going to generate the $750, but we have to put up $4,250 on hold. And what do we need to have happen? What needs to happen here for us to make money? the Dow, or I'm sorry, in this case, the OEX, the S&P 100 companies has to stay below what was the strike price? 685, which means it'd have to go from 665 to 685. It would still, the Dow would have to get up close to 11,000 for us to get in trouble. How many think that's a good calculated risk, that it's not going to go up there? So between now and next Friday, which is like 10 days away, right, about eight trading days? 8 trading days away, you're going to pick up $750 for $4,200 on holding your account. It's almost a 20% return for 10 days. What if you could do this like this, 10% return, 18% return, 10 days, times 3 times a month? Be pretty cool, would it not? There you go. Just from my own side, how many think that that's a pretty good calculated risk right there? Now, you'll have to decide if you want to do this kind of trade. I do these all the time. I like that one. So here's I'll reiterate my strategy. You take the OEX wherever it is, and you go about 20 points down and 20 points up, and you try to do a bull put spread on the bottom ones, a $5 spread, and you do a bear call spread on the upper one. But you go about 20 points away from where it is. Oh, on a dip or on a peak? Let me ask that again. The OEX, do you want to do this on a dip? Do you want to do this when the OEX has had an incredible run-up? Or do you want to do it on a dip when you think it, okay. So you want to do the bear call spread on a run-up. You don't have to do these simultaneously. But then on a dip, like the OEX drops down from 685 to 665, and the Dow's gone down a whole bunch, and the OEX is mucking around that 665 range, what do you do then? If it's down there, it looks like it's getting ready to go back up, now what do you do? Bull put spreads. And when it peaks out and runs up a whole bunch in a couple of days, now what do you do? Bear call spreads. So again, you can play the whole marketplace just like this. Okay. If they do go backwards, then you have 2 choices. You get settled for cash, you get cash taken out of your account, or cash put into your account. Right? Y'all see how they settle for cash. And they just unwind the whole thing electronically. If you, though, 2 or 3 days, let's say that the OEX does drop from 665 down to that 645, 650 range, then you got to sit there and say, like the day of expiration or a couple of days before expiration, man, I can still get 50 cents out of this deal. Right? I'm going to wind out of it. What does wind out again mean? If you put it in place by selling that, what was that one that we sold? The 640 and the 645. If you sold this, let's go this one. We sold the 650 and bought the 645, then now we buy back the 650 and we sell the 645. To wind out means we do exactly the opposite of what we did to wind in. And then the position is over. We have no more obligation. May I encourage you right now that you do not ever, ever, ever in the stock market get involved in strategies wherein if you lose, you have to put up more money. Does that make sense to anybody else here? When you buy contracts and agreeing to purchase things and settle on things and do things and deliver things at a future date, you are agreeing to put up more money. You could easily put up $1,000 to buy the right to do something. If it goes against you, you may have to bring in $18,000 more dollars. That's second mortgage the house time. You never see me doing any of those kinds of trades. And I would never, ever do them and have students follow them blindly unless they knew exactly what they were doing. When we buy an option on an index or buy an option on a stock, if it doesn't work, what do we lose? Only the cash that we have put up. And we have no obligation to bring in further cash, do we? That's why we stick with these types of options. Be very, very careful what roads you go down. Because there are other kinds of contracts that you can buy to deliver pork bellies or soybeans where you have to bring in more money if they go against you. I'm encouraging you. How many think you should be careful of that kind of stuff? It is a little bit scary, is it not, to deliver at a future date. So be very, very careful of futures contracts and things like that. Now, that's enough of a comparison. You got the point move comparison. Let's move over now and talk about calendar spreads. Page 51. This is our third definition, and this will not take very long. And I'm going to summarize this here, I hopefully in a fun way, so that you can make some sense out of what to trade. Here's a situation. You have purchased a long-term call option. You really like, let's say, Microsoft. You look out to the future. Microsoft is currently around $80. You look out to the future, way out there, and buy some Leaps, for example. You look at Leaps for the year 2000, well, now the 2000 Microsofts are now the 2001 and the 2002. Already they're writing the year 2000 Leaps, and they just now are the January options for the year 2000. So you can buy Leaps out over 2 years to the year 2001 and 2002 right now. And here we are in 1999, the middle of 1999. Let's just say for fun that you own some of these options. You purchased the year 2001, $100 calls on Microsoft for, say, $13. You spent the money. You spent, that's by 10 contracts. That's $13,000. Now, that could be an incredible trade. If Microsoft goes up back to the 120, 140 range like it has so many years in the past, ends this government lawsuit and all that, and does another stock split at 140 down to a couple more shares at 70, climbs back up to 120, does another stock split down to 2 shares at 60, climbs back up to $100 again. My goodness, look at what's happened here. Just follow that one through with me for a second. I'll put this back up in just a second. But look at that. If this stock goes up to 120 and does a split down to 2 shares at 60, I'm just saying if. I don't know if it's going to. But you know what? It's been publicly traded since 1986. Didn't even hardly do a stock split until 1990, and then it's done like 9 of them in the last 9 years. Like it does a stock split every 12 to 15 months. All we want to do is keep doing those stock splits, right, and keep making money. And what an incredible money machine Microsoft is. But it's got this little pail hanging over it. It's a software company, and even though it's making millions of dollars, it's got $20 billion in the bank, by the way. It's acquiring other companies and doing all other kinds of things. Does this government like success? Obviously not. It's amazing that in America, we love winning, but we hate winners. Right? We cannot stand the fact that somebody's making all this money. And these senators and these House Representative guys back there just look at this, and these government bureaucrats that are making $60,000 to $120,000 a year cannot stand the fact that Bill Gates is worth $84 million or billion dollars. It just bugs them. And yet all the little poor guys that are working at McDonald's are saying, yes, I can become rich in this country. Are they not? They want the rich people. They like it. By the way, do you think, if you were to take a vote right now of 100 people, poor people and rich people, who wants the taxes lowered in this country more, poor people or rich people? Poor people. Nah, poor people. They know what it takes to get rich. They know how hard it is. And they can't stand the thought of getting rich and having to pay 40 to 60% to the government. Rich people just kind of get complacent and learn to live with it. All right, I want to show you something. If this stock goes down to 60, what happens to this strike price on this call option for the year 2001? It goes down to what? 50, and you now have 20 contracts. Let's say that the stock goes back up to 140 after another 9 months or whatever, and it does another split down to 2 shares at 70. Whoa, that's pretty cool. What happens to this $50 call? And now it's a $25 call. What happens if before the year 2002 it goes back up to $100 again and does another stock split down to 2 shares at 50 for each share? Now we have a $12.50 call. How would you like to have a $12.50 call on Microsoft? Anybody here? Just mentally, where are you with that? Just having a right to buy Microsoft at $12.50. Let's just for fun take the stock back up to $112.50, just to keep the math easy, all right? $112.50. Oh, by the way, how many call options do you have now? 80. You have 80 calls. You had 10 here, 20, 40, and now you have 80 calls. And this stock, I'll have to move this up a little bit. This stock now goes back up to $112.50. I'm just doing this for mathematical purposes. And you have the right to buy this option this call option at $12.50. That's $100. It's 8,000 shares times 100 is $800,000. So, in this example, if you have the right to buy it at $112.50, you have the right to buy it at $12.50, and it's at $112, your $13,000 original investment could be worth $800,000 in a couple of years. So here's a way for some of you just to go park your money. Just park your money over there. Okay. I'm just posing this to you. Just proposing an example of something that you may want to do. But here's what what I hear, what I've seen in newspapers, what I've seen on TV, is people are starting to get big into calendar spreads. And I got to propose something to you. What they're saying is this. Microsoft is at $80. You look out and you buy that $100 call option for the year 2001, let's say, and it's going for that, the $13. So you spend the $13,000. Now, you look, here we are in June, and you look and you say, what are the $100 call options going for July? Like a month and a half from right now. Not this month, but even this month, what it's going for. What if the $100 call options for July, by the way, do you have those? What are they going for? Do you know? The July of 1999, what are those call options going for? How much do you think, by the way? Let's see how good we are. $2? You have, David? You think so? Half dollar? Oh, you're right. How much?
5/16 by 3/8.
3/8, not very much. $375. Let's just for fun sell those. Oh, just for this example. I don't know if you should or not. You have to decide this. Sell them right now. What have you done? You've agreed to sell Microsoft at $100. You better be doing this if you think it's not going to go to $100, right? Because in this example, what we've done is a calendar spread. The definition of a calendar spread, again, is that we own an option. We are long on a call option for a further out expiration date. And then, at a nearer term expiration date, we sell a call to generate income. Oh, interesting point. What has become of our cost basis now? Our $13,000 that we spent, how much have we taken in? $375. By the way, what are the $90 calls going for July? $118, sell those. Take in $1,125 instead of the $375. Now, what's your cost basis? Instead of $13,000 in those leaps, what's your cost basis? It's $11,875. You lower your cost basis. Then when you come up on July and you don't get called out at 90, then you could sell the $95 or the $100 calls for August. And you generate another $1,000. And then you do it again for September. You do it again for October, November, December. And each month you keep selling calls. What is your hope here for a while? Your hope is at the very beginning of doing this that you don't get called out. If you sell that $100, if you bought the $100 call option for the year 2001 for $13, and you sell the $100 call option for this July, and that stock runs up to 102, and can Microsoft run up to 102? If they ended the lawsuit with the government on June 28th, that stock could be at 140 in a matter of 2 weeks, could it not? And then you get called out at 100. Did you lose money or not? Yes, you lost money. All right, let me tell you my problem with calendar spreads. You think you just saw it, by the way. My problem with calendar spreads is at the very beginning, you don't want to get called out. You want to keep writing them at a strike price where you will not get called out, so you keep the option to fight another day. Now I got a question to pose to you. When you buy a call and then write a call against your call, you're creating a covered call position, are you not? But with an option rather than the stock. You would not, let's go back to writing covered call rules. Would you consider Microsoft a potential high-flying company? Yes or no? Yes, I would. I would, definitely. In writing a covered call, you buy a stock and you sell the call with the hope of getting called out, right? Because that's when you get most of your money. What do you see up here? You're buying a call and selling a call with the hope of not getting called out. I say, why do it? Why not do it on a Sears or a J.C. Penney's or a real flat company, right? So you buy that $100 call, then you can sell the 95 and be pretty sure that you're not going to get called out. Why would you write calls on Dell and Microsoft? Sell calls against your position on Dell's and Microsoft. Because didn't we say that you do not write covered calls on high-flying stocks? Yes or no? Yes? Then why would you buy a leap option and write calls against that? I just don't understand it. And yet there are people all over the country teaching that, writing books on that, and I don't get it. I see you're going to end up losing if you don't do it exactly, meticulously right. Let me reiterate. If you're going to do calendar spreads, you do those on boring stocks. Right? You do those on low-flying stocks. So you can buy the long-term call, right, that's not very expensive anyway, and then write shorter-term options against it, but no chance of getting called out for a while. When do you finally want to get called out, by the way? What if you've generated $13,000 of income over the next year, right, and you're even profitable? Then do you mind getting called out at 100? No. But when you're finally profitable. By the way, could you eventually just quit writing calls? What if you could write enough calls against your Microsoft or against your Sears Leap? Write enough calls that you've eaten up your $13,000. Every month you get $500. The next month you get $625. The next month you get $400. The next month you get, you see my point? And every month you get a little bit of money, and pretty soon, guess what? After a year, you've generated $13,000 of income. Now what do you own? You still own the 10 contracts. What'd you pay for them? If you got all the money in, you got a free ride now. So you use calendar spreads to generate income to lower your cost basis. But you don't want to get called out. Not at first. Not when you spent $13 for that call. And then you write one option for $1 and you get called out. You lose 12 grand. Do you not? Okay, so that's enough on calendar spreads. I like calendar spreads on boring stocks, I guess is my point. And then I say, though, why do them? Why do that? There are so many, that's okay, it's an okay transaction, but there are so many better trades. The same amount of money that it takes to spend $13,000 there, that $13,000 could have done 2 nearer term 10 contract or 20 contract bull put spreads. Y'all see the point there? And generated $4,000 or $5,000 of money. And you get all your cash back to fight another day. There are just better trades. So a lot of times the question is not what is, but what could be. What else could I be doing with my money? Is this a good trade? That's not a very good question. The question you should be asking yourself is, what else could I be doing with my time? What else could I be doing with my money? Okay, if you'll all turn now to page 44, when we're talking about playing the market in general, I have an idea for you. I have a very good idea, and one that I do a lot of. I like spiders. Let me tell you what a spider is. A spider is a new creation of a couple years ago that trades on the American Stock Exchange. What it specifically is a trust. It is a trust that has been established, and you can own and buy stock in this trust. Here's what it comprises. This trust, which is called a SPDR, which stands for Standard & Poor's Depository Receipts. Now, sometimes that is written like a spider, S-P-I-D-E-R-S. You know, the capital letters meaning spider. Standard & Poor's Depository Receipts. Similar to a stock trading in America called an American Depository Receipt, or overseas, ODRs, Overseas Depository Receipts. A SPDR is a trust that trades, that owns, in this SPY, owns the stock in all 500 of the largest companies in America. The SPDR here, which is the SPX, it is a Standard & Poor's 500. Now, it trades under ticker symbol SPY. Here's the way it works. SPY will trade at 1/10 of SPX. 1/10 plus 12 cents or 25 cents, just a little bit of change. So, if the SPX is $13.17, the SPY will be going for like $131, if you will, $131.76. Let's just see how good I am. Can you give me a price on SPY? See, it's going to trade for 1/10 of what the SPX is trading for. Here's what you own. You own stock in a trust. It costs you $131 plus change for each share of stock in this trust. You now own, on a weighted basis, stock in a trust that the trust owns all of the 500 stocks in the S&P 500. How does that sound, by the way? Well, okay, you're not responding. You guys all going to sleep on me? I know the lights are hot here, but can I just pose something to you? How many of you wish you owned stock in all 500 of the largest companies in America? Anybody here? Would that give you a little bit of safety at nighttime? Even if a couple went down in value, is that over the last 1,500 years, stock market's gone up. Now you own stock in 500 of the largest companies in America. Does that give you a good feeling or not? What do you think, everyone? There you go. So instead of you going out buying 10 shares of this company and 50 shares and 100 shares, why not just buy stock in this trust that owns stock in all 500 of them? Oh, and you know what? If any of those 500 companies pay a dividend, guess what? They transfer right through the trust into your account. And there's about 150 of those 500 companies that pay. I got a bunch of these SPDRs. And every time I get my brokerage statement, $8.42, $13.79, $4.62, the whole thing is lined up with dividend checks. Every quarter they pay. So every month I'm getting a bunch of dividend checks placed into my account. Sound good? So let me say it again. If the companies pay a dividend, they transfer right through the trust and bombard your account. They hit your account. So those stocks are passed right through the trust to you, the owner of the trust. You can buy this stock that trades on the American Stock Exchange. Call your stockbroker and say, what are the SPYs going for? What are they going for, by the way? Okay, so it's a little bit more than what I said. Whoops. They're going for 132.25. Let me say it again. They go for 1/10 plus change. There's a little bit of arbitrage based in there. Right? So for $132 to buy 1,000 shares would be $132,000 To buy 100 shares of SPY would be $13,200 plus change. To buy 10 shares, you see the point, would be how much? $1,300 instead of $13,000, instead of $130,000. So you can buy 10 shares here. So when I make some money on a deal, I am constantly buying SPYs. I like them. I started buying them when they were $82, $88. I sold a whole bunch of them at $98, bought them again at $92. By the way, it's rolling. You want to see it together now? See, what we have with Telechart 2000 is the ability, you'll have to look really hard at the colors there, but you'll be able to see SPX in the background and SPY, and you'll see that they just go up together like this. They have to, do they not? Because they're tied together. The SPY is the trust that owns the SPX. Okay, do you have them? See the yellow and the green? And you see that they just go tandem with each other. So if you think that the stock market, by the way, does this look like a fairly good time to buy right now? Kind of hit a dip and it's going back up. There you go. Now, if you're a little bit more robust with your investing and you would like to buy the next batch of stocks down, so there's the S&P 500, right, the largest companies, and then there's also what is called the S&P 400. Sometimes these are referred to as the industrials. A little bit more activity, a little bit more robustness, and these stocks trade the same way. 1/10 of the MDX, these trade under MDY, ticker symbol MDY, which are the S&P 400. Now, that's not 400, that's part of the 500. We're talking about 900 companies now. Y'all see that? There's a batch of 500, and now the second tier batch of 400. So if you like a little bit more plays on some of those up-and-coming companies that are trying to get on the S&P 500, there you go. That's what these companies are. Now, there's one more that's fairly new. Not only do we have the Standard & Poor's 500, and now the Standard & Poor's 400, we also have now the Dow 30. The Dow 30 are also spiders, but they go under the term, they go under what is called a diamond. DIA for diamond. You'll be buying stock in all 30 of the Dow 30 stocks by buying this trust. Now, why not buy a mutual fund? Why not do this through a mutual fund? I contend that mutual fund fees are too high. Right? You can do your own mutual fund here. And you don't have all the annual fees and all the carrying charges and all the asset management fees, right? You just own stock in this trust. And it trades up and down just like the Dow does, or just like the S&P. My favorite is the S&P 500, or the SPY. Why? Because we love you. No. Why? Because the dividends, the same, that's not totally true, because the Dow 30 pay dividends, they go through the trust too. But in the SPY, you're getting 500 companies, not just 30. Does that make sense? You're owning a trust that owns 500. Is that a broader base of America right there? Okay, so that's why. By the way, do you think that everybody in this country should know, whether they do it or not, at least should know about SPYs and MDYs and DIAs? What do you think, everyone? Because again, if you just got an extra $5,000 or $10,000 to park somewhere for the next year or two and you believe in America, you can buy these on a dip, but then this is a good place just to park money to accumulate stock in 500 companies in America. So if you want a broad base, tad bit safer place to put your money, then why not go with your SPYs? That's what I say. That's what I've been doing myself. And again, I want to walk the walk. I do these deals myself. I like these. I like the SPYs. Well, it's a buy and hold, but by the way, I'm pretty much out of a lot of mine right now because I was selling them, and then I'm going to buy them again. I've been waiting. I've just been so busy the last couple of days. I was in Orlando last week and all that, and I haven't had a chance. I was supposed to buy these. Last week, when I was in Orlando at our big Semper Financial Convention, wham, bam, all of a sudden the Dow was down. That's the time to jump back in. Because these were up around the 140 range, right? Buy them at 130 now and sell them again at 140 or 150. But can you roll these too? Now, there are no options on these, but they are marginable. Okay, just for your information. Okay, there's no options, but they are marginable. And I wouldn't doubt that sometime in the future that you would have options on a trust. You know, a stock in a trust. I wouldn't doubt it at some point in time. All right, now, to wrap this up. What is important to all of you here as you think about your future? If you really want to spend more time and with your family, what do you need to do so? What do you need to unwind in your life? What kind of baggage do you need to soar in your life? Sometimes it's a job. It's spending too much time at work. How many of you truly would like to spend more time with your kids or grandkids? And I believe, this is directed to the older people here, that our kids and our grandkids need their grandparents. Has anybody also seen in this country that there's basically a shunning of that whole thing about taking care of older people? I'm still amazed in Japan. I lived in Japan for a couple of years. If you ask any teenager in Japan what is the most important thing in their life, now here in America, what would they say? What is the most important thing in your life to a typical 14-year-old or 16-year-old? What would they say? Having fun, from clothes to Pokemon cards to what? Beanie Babies to what? Whatever they're into. In Japan, you ask any kid in Japan what is the most important thing in your life, he will tell you to make sure that my parents are taken care of. It is an amazing thing all around this world, and I think that we forget about that here in the United States. But I want to go back and remind us some things, if I can use the Bible as a base to do so. You know in the Bible it says to honor our father and our mother? You know in the Hebrew language that word honor, sometimes we spell it in English H-O-N-O-U-R instead of H-O-N-O-R, to honor our parents. Do you know that virtually every time that that word is used in the Bible, it has with it a financial connotation? To honor your parents means to take care of your parents in a financial way. And so, generation after generation, one of the biggest blessings in my life has been to move my parents, to build them a house on our 40-acre farm. So we got them a golf cart. They're about a block and a half away down the other end of our farm. They can look and see our house. We can look out and see their house and see that they're okay and their lights are on. And we can, and by the way, do you think that my kids like having their grandma and grandpa on the property? And my parents live about 50 minutes away. Do grandparents need to be around grandkids? And more importantly, do grandkids need to be around grandparents? I firmly believe that. And so if there's anything I can do here today in teaching this with any of our seminars in our whole company to help you make more money so you can spend more time with your kids and your grandkids. How about give more to your church and do more with your life? Here's a weird question. Permit me to ask this question. I understand that this is a strange question. Could you be a little bit better you if you had more money coming in? Could you do more things with your family? And it takes a lot to raise kids today. From piano lessons to karate lessons, it takes a lot. But could you do more? Could you give more to your church? Could you be a better you? See, everybody says, well, what is money? Is money going to make me a worse person? I don't think so. I think that money will speed you along the road that you're already on a little bit faster. If you're a bad person, more money will make you a worse person. If you're a good person, more money will make you a better person. And I also firmly believe, as I study everything I can study from ancient scriptures, using the Bible and the Quran, everything I study, I look in there, and I'm sorry, I cannot find anything where God wants us to be poor. I cannot find it. You look up the word lack, you can't find it. You can find it a couple places, lack and insufficiency, but it says, if you do what I say, you'll find sufficient for your needs, and if you don't, you'll find yourself lacking. But if you look up the word wealth, riches, prosperity, you will find that word everywhere. Now here today I talked about taking $25,000 and having it generating $12,000 to $15,000 a month. I showed you how to do that. If you don't understand it, go back over that part of the videotape until you get it down and you see it happening every month. You start to practice trade it every month, and you start doing it with real money every month. And you'll see that it comes about, and practice does make perfect if you practice perfectly. But you take that money, $25,000, and it provides an income for you, and it becomes 30 and 40. In 2 or 3 or 4 months, could not that 25 be 40 or 50,000? And it's still producing more income, enough to live on, and still producing more. If you look in the Bible once again, you'll see the word, if you look up the word add, you will see it a couple places. Have you seen me do the word add here very much today? Everything we do is always multiplication, is it not? Look up the word multiplication in the Bible and you'll see it everywhere. Now, I don't know about you guys, but my God is a God of multiplication. 2 becomes 4, 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32. If animals do it, if insects do it, if human beings do it, why can't our money do it? Everything can grow exponentially once we get our mind in order. And I believe that the one thing that stops us from making a lot of money is simply that we start, because of all the negativism around us, all the people around us putting us down and talking bad about making money and all that, that we start to live a life of insufficiency. We live a life of lack instead of a life of sufficiency and a life of abundance. Even the other day, I was faced with paying some money for buying one investment and putting $350,000 into an oil well. And faced with everybody around me, how are you going to do that? And I said, well, you're not going to be able to do this if you do that. And I'm saying, I'm sorry. If you want me to go where you are, and I have to now live a life of insufficiency and a life of non-abundance, I don't particularly want to go there. See, in my life, if I think they're good investments, I'm going to do whatever it takes to get the money flow going, and we'll end up with money to do both of them. So here's an interesting thing, and I challenge all of you at home that are watching this and all of you here. A lot of people say, and I appreciate you being here, because this being here today is getting yourself in the money flow. I make a lot of money. Our trading department makes a lot of money. I'm amazed at how many people say, I want to be rich, and then go out and become hermits and don't do anything and don't hang around other people and don't surround themselves with things and people that are rich. It's like saying, I want to be a capitalist and make all kinds of money and then moving to a desert island where there's nothing going on. But by coming to seminars, by reading books, by getting on wind, by talking to other people, by hanging out with other people that are on the go, on the move, doing things, you're in the money flow. Now, I really believe that there's a flow of money. There's a thinking process of money. There's like a positive energy to money. Don't get me wrong. I do not believe that there's a negative energy to money, that there's a negative energy at all. I believe that there's a positive energy, electrical energy. There's no negative, but you can stop the positive. You can stop the flow by getting yourself out of position, right? By not being around things that are happening. By being here today at a seminar and coming back to more seminars, coming to one of our Semper Financial conventions. And by the way, I recommend, how many have been to a Semper Financial convention? Wow, did you enjoy it? How many of you like to go back to another one like every 3 or 4 months? Go all the time. Make that a part of your schedule. Because how many of you go there, and it's nice to be around the speakers. I hope that it's nice to be around me once in a while. But what it's really nice to be around is other people that are walking the walk. In the elevator, going up to your hotel room right at the convention center. In the jacuzzi out by the pool, you talk to, hey, are you here for the convention? Yeah. You're the Wade Cook deal? Yeah. And then you start talking. You start seeing that there's other people doing this kind of stuff. And it gets you thinking about things, does it not? And that's where the flow of energy, that's where the flow of money comes from. And I contend that we need to be there. And why? Well, I don't know what it is for you, but I hope that this will focus in and show you what it is for me. This is a picture of my 2 grandkids. My oldest daughter's grandbaby, Ashley, the girl, and my second oldest daughter's son, Braden. And I do anything for my family, and I see the wonderful things that I've been able to do, and I continually do, and that they do, because finances are right. But the finances are right only because I firmly believe that with money, that we are stewards of that money. And we are here to not do things for ourselves. We are here to bless the lives of other people. Therefore, if there's anything I can end this with today, if there's anything I can share with you that is important to me, it is simply this. When you take $25,000 and you learn how to make $8,000 or $10,000 or $12,000 or $14,000 a month, will you agree with me on this one thing? And I really want you to think about this. If you are about doing this for yourself, and don't get me wrong, you need to buy yourself a set of clothes and buy a car for yourself and do all those kinds of things. But if you spend your life just doing things for yourself, what kind of a life will it be? I contend that true happiness, really true lasting happiness, can only be found when we're giving service and doing things for other people. And I hope that that is what money will mean to you, that you can do a lot more good in the lives of other people. And with that, I thank you again for coming. Say goodbye to all of you here at home. I hope you prosper well in the coming years. Thank you for watching. Thank you.